In this presentation, we want to take a look at the probability calculation that is shown on PowerOptions. This, of course, comes directly from one of our Friday discussions from Friday, April 23rd, where Stephen asked us, in PowerOptions, there is often a percent probability above column when doing the position analysis and analyzing rollout opportunities. How is that calculated? Well, it's calculated the same way any of the probabilities on PowerOptions are calculated. At any time, you can go to an option chain or in the search, and on any active option, you'll see the percent probability above and the percent probability below for that option. The percent probability above and below shows the theoretical probability that a security will be trading above or below a strike price at expiration. This is similar, of course, to the delta equation. The probability is based on a normal distribution calculation that's commonly used, but it can be enhanced. Now, I mentioned that it's calculated the same way as other probabilities. By that comment, I mean the probability equation is available. You can do a Google search for probability equation. There are references in many works, Larry McMillan's Options as a Strategic Investment, Hull's Options, Futures, and Other Derivatives, and even mathematical equations such as Abramowitz and Stegan Handbook of Mathematical Functions. If you do a simple Google search, you might come across the first part of the equation where it talks about the price of the stock, the strike price, calendar years remaining, and then showing an annual volatility, the volatility of the stock or historical volatility used in that probability calculation to determine the likelihood that the stock will be trading above or remain below a strike price at expiration. On PowerOptions, we refer to the annual volatility as the historical stock volatility, if you're looking at a one-year time frame. On the general searches in PowerOptions, under the Technicals tab, when you see the filter for historical volatility, that's actually referring to the 50-day volatility. Volatility can be measured in different time frames. You may see at your broker or another service mention of a 30, 60, or 90 volatility. On the stock quotes page in PowerOptions, we show you the volatilities for the 20-day, 50-day, 100-day, and 250. Of course, there may be other shorter-term ways that volatility is calculated, and even longer-term ways as well. Well, the annual volatility is a statistical measure of the fluctuation of the underlying stock. Volatility value is used in pricing models, Black-Scholes, Cox-Ross, and others, to determine the fair value of an option. As we mentioned, is also used in other equations for things such as delta, gamma, and more. Generally, of course, the higher an underlying security's volatility is, you'd expect to see more inflated premium in the underlying option prices. Now, a longer-term volatility, if you're using a 250-day or longer, will likely give you more of a smoothed value, that smoothed curve that we see, the distribution curve, on that longer time frame. Does that longer time frame account for fluctuations of past earnings? Well, yes, it does. It will take into account any fluctuations or sudden spikes, but it's smoothed over the longer time. But what about upcoming events? Right now, we're in the earnings season. I've had a couple of my stocks report today and this week, actually. I believe Apple's coming out at the end of today on the 28th of April. Last fall, we discussed what we called the EAP. Right around October 20th, we did a presentation related to the earnings that were coming up in the heart of the earnings season in November. The election, which was right around the corner, and there were still some uncertainties about the pandemic at that time. Would there be another stimulus? When would the vaccine start rolling out, and more? At that time, would using a 250-day or annual volatility to see what the securities did over the last 250 days or a year help us determine the good probabilities of options that were expiring in the next 3 weeks or 4 weeks after the election, after those earnings cycles, and while fears the pandemic was still going on? This is where PowerOptions is slightly different. We use that same standard equation that you can mostly find in those references, but we use what's called a working volatility for our probability equations. What is the working volatility? For options that are more than 30 days out in time to expiration, so today, April 28th, things that are out to June, July, August, September, and more, anything that has an expiration date 30 days out in time or more, we're using the implied volatility of that option for the probability calculation. For options that expire under 30 days from today, we're using what's called the SIV, the Stock's Implied Volatility Index. Now, what is implied volatility, of course? Well, it's the stock volatility that is implied by the actual trading price of an option. See, the Black-Scholes pricing model is used to calculate the theoretical price of an option. It takes into account 5 factors: the stock price, the strike price of your option, the days remaining to expiration, current free interest rates, and the stock volatility. Putting those into the equations, we get a fair market or theoretical price for the option. But as we know, options don't always trade right at their theoretical value. So the implied volatility essentially takes that same equation, works it slightly backwards to solve for implied volatility. It takes into account the stock price, the strike price, days to expiration, current interest rates, and the actual trading price of the option, and it can be worked backwards to solve for volatility. If that number is higher than the stock volatility, that means you have an implied volatility higher than the stock volatility, and your option might be considered overvalued. Of course, if the implied volatility is lower than the historical stock volatility, you're likely looking at an undervalued option. What is SIV, the Stock's Implied Volatility Index? Well, it is a stock indicator. You can see it on the stocks quotes page as well as other positions when you're scanning for positions in the search tools or others. But the SIV, the Stock's Implied Volatility Index, is the average of the in-the-money and out-of-the-money calls and puts for the near-term expiration dates. It's taking an average of the closer-in options as a volatility measure of how all options in the near term are expected to react in the market based on their average implied volatilities. Why would we use one over the other? Let's say you have a stagnating stock. It's been trading in a channel of only 2 or 3 points, maybe for the past month or two. It's got a tight, condensed range, but earnings are coming up. Some other event, such as an FDA Phase 1, Phase 2, or Phase 3 approval. Maybe it's a gas company or an oil drilling company that's waiting on land leases to be approved to start drilling or to start expanding an exploration field. Which volatility do you want to use? The volatility that marked what the stock has done in the past 50, 90, 200 days? Or do you want to use a volatility to calculate delta and your probabilities based on the event and how the market is expecting things to potentially move from the outcome of that event? The expected movement being the implied volatility of the option, the SIV, the average near-term implied volatilities for that option. How is the market expecting the stock to move based on these known events coming up? That is how we calculate the probability on power options. Use the standard equation used by most services, but we feel it is better to use the implied volatility, or SIV, for the shorter term positions than the stock volatility itself, looking slightly more forward-looking based on expectations rather than what has happened over the last year. It incorporates current market expectations, fears, or known upcoming events. Now, when you're comparing the probability you see on power options or the delta to your broker or another service, this is why there might be a difference. Ask your broker or your other source what volatility they use to determine the probability or delta. And remember, for option calculations, with options that are expiring under 30 days out in time, you're seeing the probability based on the stock's implied volatility index, the SIV, the average of the in-the-money and out-of-the-money calls and puts for the near-term expirations. For option calculations with options that expire further than 30 days out in time, you're seeing the probability in other calculations based on the actual implied volatility of that option. Now, the market's going to move up and down. Fears, expectations, and things can change, so IV and SIV can change as well. Of course, the stock price is going to change also on a day-by-day basis. This is why when you potentially run a search on PowerOptions, you're looking for a tight probability of something, say, with a greater than 85% probability above for a naked put, bull put credit spread, or bear call credit spread, and you run the search the next day, you might not see the same positions because the probabilities for that option or the options you're reviewing might have changed, no longer meet your requirements. Of course, this does lead to other important ideas, and we talked about the implied volatility and the historical volatility, but we're looking at the probabilities here. Of course, looking at these values, if you take the IV of your option and divide it by the historical volatility of the stock, that's the IV over HV ratio. It's considered a measure if an option is overvalued, if the IV-HV ratio is greater than 1, or if it's undervalued. That ratio is less than 1, meaning the IV is less than the historical volatility. Those are filters you can use in most searches and PowerOptions. The IV over SIV is similar to the IV over HV, but you're comparing your option's implied volatility that you're researching to the average of the near-term options surrounding it, the SIV. If this ratio is greater than 1, that means your option is considered slightly overvalued compared to all of the other near-term options around it. If your IV over SIV ratio is less than 1, of course, that means your option is considered slightly undervalued compared to all the near-term in-the-money and out-of-the-money options surrounding it. And of course, the percent implied volatility range, this again is available in most searches on PowerOptions, and you can view it on the options research table. The percent IV range is where the option's implied volatility is right now compared to where it has been over the life of the option. So if you're looking to play a volatility shift, selling into high percent IV range, or looking to buy into low IV range, expecting the implied volatility to increase and give you a little bit of extra bump in the position, those are filters that you can use in most option strategies on PowerOptions as well. So that is how we determine the probability, Stephen, on PowerOptions. We're using the SIV for the probability equation, the standard equation that's used for options that are under 30 days to expiration. For options that expire more than 30 days out in time, we're using the actual implied volatility of the option in that standard probability equation. If you have other questions on this, of course, remember, comment on the YouTube video here below. You can always call us at 302-992-7971 during market hours, or send us an email at any time to support@poweropt.com.